Welcome to our short lecture on understanding supply and demand and the basics of market equilibrium. This opening slide introduces the core idea with a simple supply and demand diagram showing where forces meet. Over the next slides, we will explore how markets find balance, what moves curves, and why prices and quantities change when external factors shift. This slide visualizes the common reasons a demand curve can move. The diagram shows demand curves shifting right or left, and the text highlights drivers like changes in income, tastes, prices of substitutes or complements, expectations about future prices, and population size. In short, when consumers' resources or preferences change, demand rises or falls, and the whole curve shifts accordingly. Here we focus on the mechanics of supply and the law that producers supply larger quantities at higher prices. The diagram and icons illustrate how profit incentives make producers willing and able to sell more as price rises, producing an upward sloping supply curve. Importantly, the slide also explains the difference between movements along the curve caused by price changes and full curve shifts driven by costs, technology, or expectations. This slide breaks down the key factors that shift supply and how they move the curve right or left. Lower input costs, better technology, more sellers and subsidies push supply right, increasing output at each price, while higher input costs, taxes, fewer sellers, bad natural conditions, or restrictive regulation push supply left, reducing output and raising equilibrium prices. The central idea is that external conditions alter producer willingness to sell. This page presents market equilibrium as the point where supply and demand intersect and the market clears with no shortage or surplus. The chart marks equilibrium, price, and quantity, while callouts explain how buyers and sellers converge on a plan, establishing prevailing values for price and traded quantity. Equilibrium is simply where upward and downward pressures cancel out and the market finds balance. This slide walks through how a market surplus is resolved, step by step, using the flow from excess inventory to restored equilibrium. When price is above equilibrium, sellers accumulate unsold stock, which creates pressure to cut prices. Lower prices stimulate demand and reduce production until surplus vanishes and the market returns to the equilibrium price and quantity, where supply equals demand. When price sits below equilibrium, the market experiences a shortage, as shown by the chart and sequence on this slide. Competing buyers bid prices higher, and producers respond by increasing output, while purchases are curtailed by rising prices. These bid and respond dynamics push the market back toward the equilibrium point, where quantity demanded equals quantity supplied, and the shortage disappears. This slide offers a four-step framework for analyzing equilibrium shifts that you can apply to any market. First, map the original state. Then identify which curve shifts and in which direction. Next, recognize the resulting shortage or surplus at the original price. And finally, trace how price and quantity adjust toward the new equilibrium. It's a practical roadmap for diagnosing market changes. Here we illustrate a rightward demand shift and its impact on price and quantity, using before and after equilibrium diagrams. When demand increases, a shortage appears at the old price, and buyers bid prices up along the unchanged supply curve. The market then finds a new intersection where a higher price supports a larger traded quantity, acceptable to both consumers and producers. This slide examines the effects of a leftward supply shift caused by rising input costs. The diagram shows supply moving in, producing a shortage at the original price, which drives buyers to offer more and pushes the market to a new equilibrium with a higher price and lower traded quantity. In short, scarcer output exchanged at higher prices is the typical result of supply contractions. The gasoline price dynamics table contrasts two real-world shocks and shows how equilibrium adjusts. In the crude cost surge scenario, supply shifts left, producing higher pump prices and lower volume, while in a pandemic, demand shifts left, lowering price and prompting producers to cut output. The key takeaway is that external shocks propagate through supply and demand to create new equilibria. The final slide stresses how anticipating market dynamics improves decision-making by monitoring shifter variables like technology, weather, and policy. By recognizing supply and demand patterns in seasonal goods or housing rents, consumers and firms can anticipate price movements. Watching these signals helps alert you to potential shortages or gluts and supports smarter budgeting, inventory, and investment choices.